Assalamualaikum warahmatullahi wabarakatuh. Welcome to my thesis presentation. It is about multi-instrument portfolio management, a comparison between single asset class and multi-asset class performance. Here is the content of my presentation today, which basically covers almost all of them, but just the points only. Now let's move to the background. By definition, investment is delaying current consumption to be put into productive assets over a period of time. To further understand, investment can also be meant as the current commitment of money or other resources in the expectation of gaining future benefits. Portfolio, always exposed to risk, regardless if it's market risk or investment risk. Effective portfolio management is crucial for investors to achieve the best returns and to protect against inflation, taxes, and other factors. Managing the risk can be done by using diversification, which involves spreading money across multiple assets to lower the risk. And investment risk can include potential loss, return below target, investor expertise, and the ability to control loss. In terms of theoretical framework, there are four. The first one is investment. As said earlier, it's about delaying current consumption to be put into productive assets over a period of time. And for risk and returns, those are two components of investing that cannot be separated. When choosing an investment requires making a trade-off between these two variables. And in terms of portfolio, it is a strategy of diversifying risk with a return that doesn't fall short among average return of other assets. It is known as portfolio management. And in terms of diversification, basically it is how to disperse the risk within the portfolio, because sometimes the risk is specific to a firm and can be counterbalanced by positive events in the other companies. Now into research question and hypothesis. The first research question is, which portfolio composition has better performance between single asset and multi-asset, and how is the portfolio performance is during non-normal market period? For the first hypothesis, basically it's just the performance of multi-asset consisting of those four assets: bond, stock, gold, and cryptocurrencies will outperform a single asset portfolio in terms of risk-adjusted returns across different market periods. And for the second hypothesis is, during the periods of market crashes, the multi-asset portfolio will demonstrate better performances compared to a single asset portfolio, while in market rallies, the multi-asset portfolio will perform better than the single asset. Now let's move to the scope. In this research scope, there are four different assets as stated earlier, and in terms of time frame, it is 6 years from 2018 to 2023, which is split into three different phases comprised of 2 years each. The first one is normal period, which is stable, price fluctuates accordingly, and crash period, which is significant market downturns with the heightened volatility, and recovery periods, which is market start to stabilize and gradual recovery, and the asset price are starting to rebound. Now move to the methodology. This will use quantitative research where all of those variables will be calculated and processed by using Jupyter software, or in this case Python programming language. And in terms of the data, this research will use secondary data from reputable sources such as investing.com, Bank Indonesia, and Bloomberg Terminal from FEB. After the data is gained, it is processed using Python, especially using Jupyter to process the whole data. In terms of sampling, there are four main samples, which is the assets that will be used for this research, and then there is additional like risk-free rate, which is Bank Indonesia 7 days repo rate. For the stock, will be used LQ45 index because it is one of the representative of the stock asset class. And for the bonds, we'll use Indobex composite bond because it is already representing both of government bond and corporate bond. And for the gold, it is one of the traditional method of investing. And the last one is cryptocurrency, which of course Bitcoin, because Bitcoin is already representing the cryptocurrency. It has higher volatility, but it will be resulted in highest return. In terms of data collection, this is basically the workflow where I fetch several data from Bloomberg Terminal, several from investing.com, and of course the main one, the risk-free rate or BI rate will be fetched from Bank Indonesia. It will be collected in the Excel and will be saved for later analysis. Now for the data analysis. First, normalizing the data need to be done by using normality test from Kolmogorov-Smirnov. Why Kolmogorov-Smirnov? Because it is the only method to handle a large amount of data points. In this case, I have 1,300 dataset for each column, which will be resulted in around 7,800 data points total. And of course, the first result shows that it's not normal. To normalize it, there are several methods such as trimming and winsorizing. I choose trimming because it is one of the most accurate way. Why accurate? Because if I use winsorizing, it will be artificially inflate or deflate the data, and it will be resulted in inaccuracies which can't be used for this research. So after trimming, the data are now 893 dataset for each column, so it will be total around 5,300 data points. 5,300 data points total. And in this case, BI rate is 0, basically cannot be used for the portfolio calculation, just as a risk-free rate. And this is basically the flow from Excel. The data that collected earlier will be calculated using Jupyter, and then after calculated, having their own portfolio combination, it will be separated into their own period. In this case, data frames, which stated earlier, 3 periods, 3 data frames, and from that it will calculate the metrics. And here's the result. As we can see, it is sorted from the lowest one, which is on the top, and the highest one, which is at the bottom. I have to split it into 2 metrics because if I combine it into one, the result from the expected returns will be so tiny that sometimes it cannot be seen. So it is better to split it into 2. And as displayed in this resulted, the portfolio which consists of more than 2 assets or 2 assets or more can have a higher expected return. This is during normal period metrics. This is during a normal market period. And this is during crash period metrics. As we can see here, a portfolio which consists of 3 or more assets have a higher expected return, better than the single asset or even the market at that time having crashes. The one that has the highest return is surprisingly a portfolio which consists of bond, gold, and cryptocurrency, in which these have an inverse effect of the stock market. And now for the recovery period, as stated earlier, during this period, all of the prices started to rebound and started to normalize. And in this case, almost all of this, either single asset or multi-asset or even the market, resulted in a positive expected returns. But of course, the one with the highest expected returns are the one came from portfolio which consists of multiple assets. And to determine if the results earlier can answer the hypothesis, it will need to be conducted statistical test. The first statistical test to validate if this can answer the first hypothesis is by using ANOVA and post hoc. The first one is of course ANOVA test. To use the statistical testing, I set a parameter which is basically sorted by expected returns, and then the portfolio which consists of those assets will be put into their own group. For example, the group 1 is for the single asset, group 2 is for the combination of 2 assets, and group 3, which is a combination of 3 and 4 assets. Why 4 assets not put into their own group? It is because the 4 asset, the only portfolio that has 4 assets is only one. And if I put it into their own group, it will result in crash. Sorry, what I meant is the software error. So the result, there are statistically significant differences in expected returns. As you can see here, the significance are 0.023. And it will be further highlighted in the post hoc test, where the portfolio, which consists of 3 and more assets, has statistically outperformed single asset. As you can see, the significance are 0.032, and the same thing happens with the lower one, the 3 and 1 as a dependent variable, and it has same result, 0.032. This result validates the first hypothesis, which is H1. How about the second hypothesis? The second hypothesis will be use independent sample t-test, which to measure to compare each period. In this case, the first one is the first period and the second period, and the result shown that a portfolio which consists of gold, Bitcoin, and bond shows statistically significant increase in returns. And in this case, the significance of the two-tailed of those assets are 0.045 and 0.041. And in this case, the data is accepted as the data is normal. And the second one is from period 2 and period 3, which is from crash to recovery. In this case, although all of those portfolio has rebounding during the recovery period, in this case, multi-asset portfolio, particularly those combining bonds and gold, show significant improvements, reflecting the benefits of diversification on this era. This basically validates the second hypothesis. Although I test from period 1 to period 3, it resulted all of the data is rejected, because the first one is normal, the number 3 one is the price going to the asset is going to recover. So let's move into result and discussion. So the result is, during all of this market period, it can be determined that portfolio that are composed of multiple assets are able to outperform the single asset portfolio or even the market itself. Like, for example, normal market period has expected return of 0.10%, and the crash market period has an expected return of 0.46%, and the recovery period, although all of those are rebounding, the one with the highest rebound is actually the portfolio with all of these asset classes, which has an overall expected return of 0.12%. And yes, all of these have a negative Sharpe ratio, which indicates suboptimal risk-adjusted returns, but it is about the performances of their portfolio, which measured by the expected returns. And basically, that's just it from my thesis presentation. Assalamualaikum warahmatullahi wabarakatuh.